All right, good afternoon, folks. Welcome to today's slightly later midday webinar. We are going to be having a look at the non-farm payrolls data today. So we have got fairly pivotal data for the Federal Reserve to make their decision on future rates for September and also going forwards after September. So from their recent communications, the Fed has been slightly more dovish, meaning they are looking to cut interest rates soon. Markets have priced in a most likely a cut for September. So the outcome of this is very unlikely to affect the outcome for September's rate decision, which is, I think, a very high probability for a rate cut already. We're really going to be looking forward for further confirmation of future rates. So September, not going to change, but how could the following rate decision be affected? Could we see the potential for further rate cuts? Do we get a much weaker reading within this labour market, prompting the Fed to confirm their suspicions that the labour market is weakening aggressively and they ultimately need to cut rates in an effort to boost the economy and to maintain job stability? So we're really looking for confirmation on this. Now, they're in a little bit of a sticky situation. There has been fairly resilient inflation data recently. It hasn't quite been going down as much as potentially they would have liked it to. PPI data seeing some upside, as well as CPI data, so inflation for producers as well as inflation for consumers, both slightly increasing. We had a recent PCE, which again is another form of inflation, generally considered to be the Fed's preferred gauge for inflation. It's same as the previous CPI, consumer price. It is a basket of goods that the change in price is tracked from. For PCE, the basket of goods adjusts based on what consumers are actually consuming. So it's generally considered to be a little bit more representative, of what people are actually consuming, therefore a better gauge for inflation. Now, with that recent PCE, generally the core PCE is considered slightly more relevant. Core datas, when we're in relation to inflation datas, generally is going to be excluding more volatile assets. So food, electric, things like this that are more subject to bigger increases or decreases over a period, slightly more volatile, get removed from that. Now there's another one called Supercore, which is a even more refined version of PC, which has been increasing the last 3 months. So some of the metrics for inflation are increasing. Across the board, they're fairly resilient and not really going in the direction they would want. Labour market aside, that would be enough for the Fed to continue holding rates most likely. Certainly should be a cause for concern. However, they did state from their recent Jackson Hole Symposium that with the recent jobs data, with this decline in the labour market, that is really causing their concern and their worry, and meriting, in their eyes, a more dovish tilt on monetary policy. So really driven by labour market, despite the fact of that sticky inflation, the labour market data, the lack of jobs, recent non-farm payrolls figures have come in fairly high. We had a 147,000 jobs created 1 month, and the month before that was 139,000 jobs created. But these datas were later revised. So that initial figure, what we thought was 147,000 jobs were created, actually got revised down the following month to 14,000. So a massive decline in that number, the one before from 139 to 19. So the initial data is coming out, not particularly accurate, and massively revised to the downside. So we saw that last time, and we saw a very big move, a very aggressive move for the US dollar and the US indexes on this much weaker reading. The Fed also has a dual mandate, right? They are looking to create price stability by keeping inflation around 2%, whilst also trying not to crash the economy, right? Trying to maintain stable jobs without wild unemployment. So they're trying to balance these two things, and they're trying to increase and decrease interest rates in order to keep these things balanced. So with one side of the scale tipping too far in that direction, in this case jobs data, going too far to the downside, seeing too many red flags in that sense, that is enough for them to say actually maybe it's time for us to start cutting rates to stimulate this. Now, like we said, it's not really going to affect the September meeting, right? 97.4% probability that we do see this rate cut in September on the 17th, which is a couple of weeks from now. It's really going to be going on from there. You know, where do we see this later on down the line? And this is the Fed CME group. We can get a few probabilities for upcoming, most recent, or most immediate releases. Where is that? Sorry, there we are. So there's the current probabilities, and then we can see going forwards what are the probabilities a bit later on. This one very certain. Going forwards from September into October, we have got much less certainty, right? It's a 52 versus 42 split. So much less certain. This is where it's really going to be very pivotal for actually which direction could this go later down the line. Do you care as there's a in this case, not so much about September. It is about, does this change from a 56 to a 70, and later down the line, do they get a really weak reading, and the dovishness kind of comes in full swing. So that's more what we're looking for. Now, there's going to be a few datas coming out today. So we have got average hourly earnings, non-farm payroll, which is considered to be the bigger piece of data, the headline figure that you'll see coming out first, and unemployment rates. So they're kind of the three main figures that come out on the first Friday of every month, and they give us a good indication of just general labour market conditions. Average hourly earnings, as it sounds, how much are people earning on average per hour for the month of August on a monthly and yearly basis? Are wages going up? Are people earning more money? If people are earning more money, spending more money, that could prove to be inflationary, and therefore lead to a more hawkish tilt for the central bank. By itself, probably not the biggest of figures, but that idea of trying to connect up from what does this mean for the actual central bank going forwards, more money being earned by individuals, potentially spending more money then, and therefore inflation could creep higher. Then for non-farm payrolls, number of new jobs created for the month of August, excluding farm, agriculture, and military because they are seasonal. Again, if there's more jobs created, a strong labour market, the economy is doing well, more people potentially earning money, more people spending money, possibly inflationary for the US. And unemployment, same thing. Unemployment rates, how many people are currently unemployed? 4.2 to 4.3%. Now, unemployment rates are a massive figure that they'll be watching, but they've been fairly stable. They've been holding between 4%, 4.2, 4.1, maybe up to 4.3, but generally holding around this fairly okay figure. It's not crazily out of control, but it is fairly stable. Which does mean, although we have seen a reduction in jobs created, it hasn't quite translated into unemployment, right? Jobs aren't necessarily being made, but we're not seeing mass unemployment, which gives them a little bit of wiggle room potentially. So this is what we're looking for today. So if we start to see weaker data, so in this case we see 75 is the census for non-farm payrolls, 75,000 new jobs created for the month of August. If we see a much lower figure, again that supports the idea for the Fed to start cutting rates more aggressively. It means that they might be looking to cut, obviously in September, but potentially going into October as well. If we start to see some resilience and a bit of a bounce back from non-farm payrolls, I think obviously nothing for September, it's going forwards. So we'll have some data in between now and then to either support or go against that higher reading. Gives them a bit of wiggle room, but I don't think it's really going to change too much on the picture at the moment. But we'll see how that figure comes out. And then unemployment, same thing. If we see a higher figure for unemployment above 4.3, that again would accelerate the rate at which the Fed would be cutting interest rates. And if we see a lower reading, stronger labour market, more people working, less unemployed than were expected, that could potentially go against the Fed's idea for more rate cuts to come. Now, in terms of us trading this, I think we're going to probably trade the currencies for this. I'm a little bit conflicted when it comes to the indexes for this data, just because if we get a big reading for unemployment, it's kind of good news is bad news for indexes. So if we get unemployment much higher, that is not particularly good for companies, right? But it does mean the Fed will cut rates, which ultimately is good for companies. So it can be a bit of a good news is bad news situation, and sometimes it can be a little bit choppy for that reason. And since we're kind of at a point where we're expecting some big unemployment figures, I'm probably going to focus on the currencies for today. Higher reading, or sorry, stronger labour market, depending on the data. Stronger labour market, stronger US dollar on the probabilities shifting to a rate hold down the line. A much weaker reading for labour markets, higher unemployment, lower job creations, we would see a weaker US dollar on the potential for future rate cuts to come. So strong labour market, strong readings, strong dollar, weak readings, weaker dollar. That would then be the inverse for the index, but again, it's not quite as clear cut at the moment. So let's have a quick look at this calendar. As we said before, the consensus that we see isn't the only consensus. We kind of get the middle point of all the consensuses provided by institutions and their analysts. There is, however, a range of consensuses, so it's kind of like a bit of a bell curve, if you will. There is going to be this range we've got for non-farm payrolls, we say 75,000 jobs. Some analysts might think that actually the higher end of this could potentially be much bigger. It might be 150,000, and then the lower end of this could be as far down as 20,000. These are the kind of extremes of what analysts thought this data could come out as. We then see that kind of middle point. Now, in order to get the biggest moves from this data, we would really ideally like to see this figure come out either above the high end or below the low end of those jobs, of that data, sorry. So that would cause the biggest moves because it's completely outside market expectations, and therefore there is lots of price adjustments that need to be made in order to price in this new data that was completely out of the blue. Above or below this provides a good move, but not the biggest move. Outside the entire thing provides the biggest move, and then on the consensus is subject to some more choppy conditions. We thought 75, it's coming at 75. I don't need to adjust any of my positionings because I'm already in for 75, right? So for us, for what we're doing today, we would like to see it above this range. Now, we'll try and go through the strategy quickly, but let's just see what that is. So unemployment, that's for Canada. Canada has the same data out at the same time, but US data is going to be more important in this case. So average hourly earnings, the consensus was for 3.7, so we got the consensus on the end here. The low end of that consensus is 3.6, and the high end is 3.9. For where are we? Non-farm payrolls, we've got the consensus of 75,000, low end of 0, not particularly optimistic from the analysts, and a high end of 144. So either we hit rock bottom with 0, or we come in above 144,000. We also get revisions from previous ones. So we might find if we get a bit of a nothing figure from this for 75,000 in line with the consensus, and the previous data was revised higher or lower, that could take the reins and that could cause the move. Unemployment 4.3, the consensus 4.1 on the low end and 4.4 on the high end. So a fairly wide range, especially for unemployment. That's normally a bit tighter. So there's clearly uncertainty around the jobs market at the moment. So in terms of how we're going to trade this, we're going to trade and implement a straddle. I'm just going to talk about the standard straddle today. There is an option straddle, but I won't scare you all with the options talk just yet. So for the straddle, what we're looking to do is we're identifying a range of price before a data comes out. Right? We are working on the basis that at 1:30 there is going to be data out, and there's a big potential for volatility. We don't know which direction, so this is an unbiased trade that we are taking. We just know it's very likely that we will see volatility in a given direction. Yeah, I saw this as well. There's some technical issues from the data provider for non-farm payrolls, which is not going to bode very well for this setup. However, it might mean the data is slightly delayed, but ideally it comes out on time. So what we're looking for, is a 1 to 2 hour range of price before the data comes out. As we say to you, you don't want to enter a trade just before a high impact data release because you're essentially rolling the dice. We don't know how this data is going to come out. So it's just, how are we supposed to trade this? So lots of people have the same idea, right? There's a kind of industry standard. You're not going to jump into a trade ahead of non-farm payrolls. Generally leads to a bit of a range-bound market ahead of this data, which for us is good. We're looking for this range, and we're looking to identify the high end of the range and the low end of the range. If this market is trending, unfortunately, we cannot trade the asset. It has to be range-bound and sideways. Just before this data comes out, we are looking to place an order to go short below the bottom of the range, and an order to go long above the top of the range. Now, this is in the hopes that this data comes out and it causes some volatility. We get an aggressive breakout in a given direction, and we manage to capitalize on this move up regardless of what the data comes out as. That's basically the strategy. Now, problems that can arise with this kind of a strategy is we're trading a time of very high volatility, and high volatility comes with some risks. We might find that with the extreme volatility, everyone trading in a given direction, all in the same direction, there is a general lack of liquidity. Now, what this means for us is that as we place our order, the market breaks to the upside. We can't get filled at the price we want to, right? There just simply isn't the liquidity for us to get filled at this price. It's moving too fast, and everyone's going in the same direction. What this might mean is that we get entered into our trade somewhere up the move, which isn't great because it can leave our stop loss in the middle of nowhere. We're now halfway up a move. Any pullback, we're in a bit of danger. In terms of trying to mitigate the risks of slippage, trying to trade a more liquid asset, something like euro dollar that has got tons and tons of money going through it, gives us a better opportunity to get filled where we want to. So trade a liquid asset and also make sure to use a buffer between the breakout point and the actual entry level. So slippage, getting entered where we don't want to. Another thing we could see is that if this data comes out mixed, some good data, some bad data, or in line with consensus, we might find actually this market just chops around. That could leave us subject to lose both of these trades. Not a massive amount you can do with this. Again, best thing to do would be to, as soon as you get entered into one trade, cancel the other order, if you're quick enough. Sometimes it can whip very quickly. So if you have the time, as soon as one gets triggered, cancel the other. Alternatively, if you're a bit too concerned, I would say use 0.5% risk on either side. So you've got 0.5% for the long, 0.5% for the short. Worst case scenario, we end up with a 1% loss. Another thing that can happen is going to be an increase in spreads. So as we hopefully are semi-aware, when we are looking at the current price, that is the current price of the asset. However, we don't get entered into our trades on the current price. We get given a slightly worse price above and a slightly worse price below. That is going to be the spreads, right? That's the spreads the broker provides. That is the commission they ultimately take on a trade as soon as you pull the trigger. Now, during times of high volatility or less liquidity, generally riskier times to trade, the broker is going to increase these spreads. They're going to take a bigger piece of commission during those times that it's a bit riskier. Now, in terms of our trade now, what this could mean, we've had this a couple of times, is where the spread is like this, our orders are waiting, just before the data comes out, this spread widens beyond the range and we get entered into the trade before the data comes out. That's obviously not ideal because that completely invalidates the entire trade setup. Again, trying to trade a liquid asset hopefully keeps the spreads as tight as possible, and making sure you have a buffer between the breakout and entry point also can give us a slightly better chance. There are a few of the risks. Let's have a look at what we've got. So again, we need to try and find an asset that is fairly range bound and also obviously going to be affected. Now, I think dollar yen might be an interesting one to look at, but it really depends now on dollar CAD. Let's look at dollar CAD. Dollar CAD's a bit tricky just because there's data on both assets. So US dollar and the Canadian dollar both have data at the same time. More potential for a choppy market condition, or bigger potential for a bigger move. But I'm also going to I'm going to do an option straddle. We'll talk about it afterwards. But don't worry too much about it for now. Let's do that on that side, and let's do this on that side. Gold is good. Let's have a look at gold. Get rid of timer. Might miss the whole thing. All right. Oh yeah, that's not bad. Okay. I do want to try dollar yen. So yeah, let's do gold and dollar yen, shall we? Gold dollar yen again. I would do an index, but it's just not quite as clear cut as to the direction. Now let's go for gold. So we're identifying this range. What have we got in terms of a range? I'm going to go from here, 12 minutes past 12, down to the current price. For me, that's probably enough of a range. If you wanted a slightly bigger one, you could go down there, but maybe a little bit too large. Obviously, that range goes back for some time. Dollar yen is certainly a bit trickier. It's a shame because we had a very nice range going into this, which is why I initially picked it. But unfortunately, we haven't held that price. Could take something like this. It ends up being a bit massive. We'll give it a go anyway, just to see. We're on a 1 minute chart, but we're on a 1 minute chart. It doesn't necessarily matter what time frame you use, just because it's going to be, the 2 to 3 hour range anyway. But sorry, 1 second. We've got the squawk system, so when you're trading this data, obviously it's good to hear what's going on as quick as possible. One of the news sources that we have looked at a little bit in the past or this week is Financial Source. They'll shout out the data as soon as it comes out, so hopefully you'll be able to hear it in the background when this data happens, but we'll try and keep an eye on it as well. Okay, where are we? 127. Now, you don't want to place a trade too early because you don't want to be entered in the trade on early volatility before the market actually starts to move. Now, we might be close enough now to start placing the orders for gold. It's a nice range. We'll do about 2 to 1, just over a 2 to 1, 2.5 to 1 on the risk to reward. It should be fairly volatile, so I think that should give us enough. We'll do about £1,000 risk on each side. Okay, so that one's on there. Again, hopefully we don't get any early volatility. Dollar yen is going to be a bit trickier, so I'm going to put the orders to go long above the highs now because there's enough space between here and there. Downside order will have to be a little bit later, which is a bit unfortunate. Right, let's pop that in. We've also got an option straddle on as well, which we'll talk about again in a sec. Let's hope this doesn't break out before the data comes, which is a risk of doing it a bit too early. Obviously, when you're taking an actual straddle, I wouldn't recommend doing a bunch of different straddles all at once. Pick an asset, focus on it, and just do that one straddle. Otherwise, you're going to be over risking, and you end up in this position where actually you've had to place the orders a bit too soon because you spread too thin. Well, okay, let's place it now. see how this goes. So, what's the time? So it sounds like the data is due to be released on time. 10 seconds till the data. I see that sends us in now on the spread, unfortunately. So that's not ideal. Okay. Big move up there. 22,000, so way below the expectation. 4.3% on the. Sorry. Cool. So, oh well, that worked out okay. So we've got the breakout to the upside. We did get into on the spreads initially, so that was a bit lucky. The order for the other position now can be closed, so I'm going to move the stop loss then to break even. You know, at this point, you could make the assumption that either I'm going to close that trade now and I'm going to take the profits for these moves, or potentially I'm going to allow this to run. Do we think it's got the potential to continue further? And if that is the case, then obviously we can allow it to do so. Now let's delete the opposing orders for both these other positions, and then these are set to a 2-to-1. Doesn't seem unreasonable, but we can sometimes see this data snap back to where the previous price was. So both are about 1.5 to 1 at the moment. Let's just have a quick look across the board and see how the other assets are reacting. Sorry, just on the data. That came out lower than expected. So we had softer than expected data. So let's have a quick look. Where are we? So let's update. Not on there. Let's go on this one. Okay, so weaker than expected data. We had a big reduction in non-farm payrolls. That was one of the key data that they were looking out for today. That was really the driver for this move, headline figure, and it was below the consensus of 75 down at 22,000. Within that low end, which was 0, but within the low end, so it was lower than expected. Non-farm payrolls at 22,000. Unemployment did come in on consensus 4.3, obviously an increase, but still increasing. Sorry, on consensus, but still increasing. So not great for unemployment data, but still within the expectations. Non-farm payroll there really being the choppy figure. Now, if we were to be trading, say, dollar CAD at the moment, both Canadian data and US data came in negative, so you might find actually you get a bit of a choppy move between those two. US dollar data would probably take the lead in weakness, but you could see that to be the case. So yeah, those moves are still continuing. Gold's making its way up towards target. Is that back up to an all-time high again? Yeah, just creeping up to an all-time high for gold. So 2.5 to 1 is the target there. It's just over, so we're at 2 to 1 now. So I'd probably be looking to close that trade now, to be honest. I'll move the stop loss here, and we'll just give it a chance to go anyway. And that's it. So let's just see what the indexes are doing here. So for the Nasdaq, very choppy. So as we were saying before, this is probably the worst case scenario for this kind of a trade. We've got the range beforehand, and we have the orders either side. Now, bad employment data obviously isn't great for companies and isn't great for stocks, but it also means rate cuts, which would be good for stocks. So you end up with this kind of choppy move, which is why we decided to focus on the currencies for today. And in this case, we'd have been stopped out and probably stopped out again, and then it ultimately finds direction, which goes quite nicely into the options straddles, which won't go into now. But when we do go into options straddles, it's a way we can essentially remove all the negatives of a standard straddle by applying options contracts instead. Sorry, let me just go back to these questions quick. Will we do enjoy the safe straddle? Yes, so sorry, I didn't see that question before. Apologies. Really going to be base C. Didn't trigger us. That's a shame. It's pretty. Well, hit the target, but unfortunately it didn't enter us in the or exit us from that position. Let's just refresh. Maybe it did. That's a shame. So yeah, you can have a selection of different assets. So in this case, we had potentially euro dollar, potentially cable, potentially dollar yen, whichever one then has the nicest range. Unless you have a fundamental reason to trade one over the other, you can just pick whichever one has the best range. My platform had no issue placing the orders, probably due to the expected volatility. Do you ever have them? I've never had problems with placing the orders beforehand. I've certainly had problems with being slipped on Dow Jones. I had a pretty horrendous slip, way down move, which I then just had to kill it as soon as possible. With a rejection like this, that would probably be time to close that trade. But yeah, that's the thing with trading these. You can have potential issues with mainly slippages, mainly after that order has been placed. But yeah, not a bad move. It's nice when the straddle goes well. It's a big move, and you can make some good money in a relatively short period. Is this strategy personally employed? Is it slippage? Yeah, I did just take a trade on this as well. I had an order to go long on dollar yen, so I did that just after I did ours. So yeah, I implement this. I generally have a preference on direction. So my preference for dollar yen was weaker dollar supporting future cuts. I thought the upside potential for this wasn't great, and the yen has been showing a bit of strength recently. So my preference there was really only taking this trade if we see dollar weakness and dollar yen upside. So I only have one order to go long. So yes, I implement the straddle as such, but I do make a few small adjustments. But it's a good thing to practice. It's a good thing to trade, and I would recommend giving it a go. High impact data is really going to be the ones to focus on. Otherwise, you just won't really get the clean moves. And yeah, so that's non-farm payrolls. That happens every first Friday of the month. They're not all this clean, but you do get some good moves. Cool. If there's any last questions, please feel free to ask away. Otherwise, I'll just let these go until the end of the day. See if they manage to get there, or see if we end up pulling back to the pre-price we started at. I back my losses for the week. Nice, very good. Glad to hear it. Actually, wouldn't trade this. I did trade this on the prop firm account. But if you are trading on a prop firm account, you do need to make sure they allow you to do so. Some of them will say you can't open a trade or close a trade within 15 minutes of a data release. Mine isn't the case, so I can trade these. Good. Glad you all got the opportunity to give it a go. Yeah, so that is, on another note, the end of week number 1. So for those of us on the 1-week course, I hope you've had a very good time with us this week. If you have any questions before you finish, obviously please do feel free to let us know, or after next week, obviously still welcome to get in touch, and hopefully we'll see you again sometime down the line. For the rest of us, again, hopefully you've had a good week. We're going to be going into week number 2, which is going to be looking at execution types, price patterns, and Fibonacci retracements and extensions. All very good tools that we'll be having a look at later next week. Lots of them do have rules around data just because of the volatility. It can be a bit risky. You'll have a 4:15 today. I don't think it's on anything specific. If you have anything you want to go through, then it'll be Mark with you, so he'll be able to get that sorted. Awesome. All right, well, thank you very much, everyone. If you have any questions in the afternoon, please feel free to get in touch. If not, I hope you have a great weekend. It's sunny here in London at the moment, so hopefully that holds up for the weekend. Cheers, folks. Catch you later.